Hi folks, and welcome to this video that illustrates business combinations using the purchase of shares to affect the business combination. So you'll remember that we said earlier that because we have a purchase of shares, the transaction is directly between the parent company Red and the shareholders of Saks, not Red transacting with Saks directly. Red is transacting with Saks' shareholders. So therefore, the only journal entry we're going to make is the journal entry that Red would make on its books. And that journal entry to record the investment is going to debit it for $960. But notice that we're also debiting professional fees expense because there was a cost for Red to do up the deal, to get the lawyers, the accountants, the consultants who were involved to help Red set this deal up. Well, those costs don't add any future value to the investment. So we don't capitalize it into the investment. We consider it a sunk cost. So we just debit professional fees expense for that amount of $18,000 and credit cash for $978,000. Now in the second part of Part A, they ask us to prepare a consolidated balance sheet. But before we can do that, we need to see if there's any goodwill created on this business combination. So what we're going to do is we're going to calculate goodwill by first calculating the acquisition differential. And we said earlier, and in the text, they mentioned that the acquisition differential is the difference between what you paid for the investment, which is $960, and the book value or carrying value of the company that you now control, which is Saks. And we can see that the carrying value is assets less liabilities. Carrying value or book value is assets less liabilities. So the carrying value of the net assets is assets less liabilities as they sit on Saks' books. Well, the assets total $1.26 million, the liabilities total $612,000. So the difference between assets and liabilities, or the book value of those net assets, is $648,000. So the acquisition differential is the difference between what you paid for the investment and the carrying value of what you got in return for that investment. And that's $312,000. That represents the amount you paid in excess of the book value that you now control in that sub. But why did we pay $312,000 more? Because we bought fair value in Saks. So we have to reflect the fact that we bought what we perceive to be the fair value of Saks. And that fair value includes any of the increments, the amounts over and above the carrying value of Saks' assets and liabilities to get them to what we would call fair value. So when Red goes out there to buy or to quote its price of $960,000, what it's prepared to pay for the investment, it's because they must see some value in the assets and liabilities that exceed what Saks has them booked at. And you can see, if you try and justify why you paid $312,000 more if you're Red would say, well, we think that the current assets are worth $468,000, not $420,000 that Saks has them at. So we paid for that incremental value of $48,000. We can also see the same thing for PP&E. Saks has the PP&E booked at net at $840. But Red thinks it's worth $972,000. So part of what they paid for when they paid their $960 was that additional $132,000 in value. Similarly with the patent. Saks had the patent valued at $0. But Red thinks it's worth $72,000. So that's additional value that they paid for as part of their $960,000 price. So you've also now, on the liability side, in this case, we see the liabilities in Red's estimation are worth more. Saks has got the liabilities valued at $360, but Red thinks they're worth $24,000 more. That is $384,000. So that's a higher number, $384, but that's also reduced value or an increased obligation that Red is taking on. Okay, so we just put brackets around it because increments are good things, right? But when your debt goes up, that represents a bad thing for Red, right? So we're going to deduct it. So when we add up these four numbers, we're going to get incremental fair value of $228. But that only counts for part of the $312,000. So in other words, I know I paid $312,000 more for that subsidiary to get control over it. I can account for $228,000 when I do a carrying to fair value comparison, but the rest that can't be accounted for goes into goodwill. Now, we also know that under this in this question, they also added a section there on the value of the workforce. So in other words, part of that $960,000 that that Red paid to acquire control over the sub-Saks, they paid $100,000 of that $960,000 because they saw value in the workforce. Well, there's no human capital being valued on the balance sheet under IFRS 3 for business combinations because only identifiable net assets can be included in this goodwill calculation. When we say the assets and liabilities have to be identifiable, we mean that they must be able to separately sell, transfer, license, rent, or exchange them. And you can do this with all other assets, liabilities, all kinds of intangible assets like trademarks, in this example, a patent. These things can be bought and sold. Copyrights, buildings, vehicles, all those kinds of things can be bought and sold. But, however, human capital, you're not in the business of selling human capital or buying human capital, right? You don't do that. So the idea is they're not considered to be an element or an asset that can be separated from the business and separately valued. So for that reason, and by the way, they do say this under IAS, International Accounting Standard 38 as well. So the fact that you can't do it, we don't include it in the goodwill calculation. So they did pay, as part of this $960,000, $100,000 of it includes the value that they saw in the workforce, but that all gets sloughed off and included in the calculation of goodwill, but not as a separate line item in the allocation of the acquisition differential is our point. So now, you would say, well, hey, now we're in the position to do the consolidated balance sheet. Well, you are. You really are. But what I wanted to review with you was, even though you're ready to do it, and this question, to do the consolidated balance sheet, this question doesn't ask you to do what I'm going to do with you now, but I want to see if you can make the acquisition eliminating entry on the third set of books, that being the consolidated books. Because don't forget, both Red and Saks are carrying their assets and liabilities at carrying value, right? It's only Red that's assessed this incremental value and that you've allocated up here. All right, this incremental value is what's been associated by, devised by Red. Now, here's the issue. Don't forget, under the acquisition method of accounting for business combinations, when you prepare consolidated statements, you include the assets of Red at their carrying value and add to that the fair value of the assets and liabilities of Saks. So you take the carrying value of Red's assets and liabilities, and to that you add the fair value, as seen by Red, of Saks' assets and liabilities. Well, don't forget, Red's got them set up, their own assets set up at carrying value, and the liabilities at carrying value. So too does Saks. So if you look at the question, Saks has set up their assets and liabilities at what they believe to be their carrying value. Just because Red's seen an additional value, Saks says, well, you've seen it, that's great, you paid for it, fine. But now to do the third set of books under the acquisition method, if neither Red nor Saks are carrying Saks' assets and liabilities at their fair value, the consolidated entity has to reflect them on the consolidated statements. So what we would do on this third set of books is we would make, on the third set of books, an entry. And the entry serves two key purposes. It's going to set up all the increments and or decrements of those current assets, PP&E, patents. It's going to set up the goodwill. But it's also going to eliminate the investment account. It's not going to eliminate the investment account on Red's books. Red still got the investment at $960. But on the consolidated books, it has to eliminate it. Why? Because it would be like double counting. Because don't forget, when we did this calculation up here, we said that investment is divided into pieces. It's divided into the $648,000, which is the carrying value of the sub, Saks. It also includes the fair value increments and decrements and goodwill. So these are the three pieces here. I'm just going to bold them for a second. These are the three pieces here. The three pieces here that make up this $960,000 investment, right? So with that in mind, if I included the investment, but at the same time included the increments and goodwill, that all the increments that I'm setting up, account by account, and the goodwill, and the book value of the sub, I would be double counting the investment. I would get a consolidated balance sheet that doesn't balance. If you don't believe it, try it yourself and see what you get. So that's why at acquisition, to facilitate the preparation of the consolidated balance sheet, so I'm just going to say to facilitate the preparation of the consolidated balance sheet, we are going to prepare this worksheet entry. So it's on the worksheet. Now in our course we don't do worksheets, we use the direct method, which I'm going to show you in a minute when we do the balance sheet. But the idea is you should know that it exists. So what do? Well, this should look familiar to you. This is assets less liabilities. These two guys here add up to your $648,000, which we said is part of that $960,000 investment, right? We're going to eliminate the common shares and retained earnings of the sub, Saks. Why? Well, because don't forget, we are preparing as red consolidated statements for our shareholders. Who are the shareholders in red? They don't care about the common shares of Saks and the retained earnings of Saks. They care about the common shares and retained earnings of red, not Saks. So we eliminate them, not literally from Saks's books. We don't do that. But what we are concerned about is the fact that we don't want to double count that equity, okay, that book value that we now control, right? So the idea here is that the only way we can eliminate, or I shouldn't say eliminate, but the only way that we can eliminate the investment account is by adjusting on the consolidated statements so that we're only seeing the common shares and the retained earnings of red, because the consolidated statements are being done for the benefit of the shareholders of red. They don't care about shareholders of Saks. They don't care about the retained earnings of Saks. We are interested in only the common shares and retained earnings of red, because we're preparing the statements, the consolidated statements, for those shareholders, those of red. So we would eliminate them from the consolidated statements only, but not from Saks's. So this is done to facilitate the preparation on the consolidated balance sheet. So we eliminate those two guys, right? And now we're going to set up all the increments on the consolidation side. Why? Because don't forget, Red wouldn't have set these up, and Saks didn't set these up anywhere in their separate entity statements. They wouldn't, because Red didn't purchase the net assets of Saks. Saks is carrying everything at carrying value. So the only entity that could set it up using the acquisition method is Red, but on the consolidated statements. So that's why we don't have the investment showing, because it would be double counting. And oh, by the way, don't forget, you also have to set up under the acquisition method that we talked about earlier as the approved and accepted method of accounting for business combinations. We have to set the long-term debt up at its fair value on the consolidated statements as well. And that's gone up in Red's estimation by $24,000. So that's the worksheet entry that we're going to use to facilitate the preparation of the consolidated balance sheet. So now, with that in mind, let's now go ahead and prepare the consolidated balance sheet. So what I'm doing here, I've got some things color-coded because we're preparing the consolidated balance sheet at August 1st, year 3. You can see our statements in the question are at July 31st, year 3. So we're looking at everything. We're taking all these opening balances for Red and for Saks at July 31st. But don't forget, when the business combination happened on August the 1st, which is the date we're doing the consolidated balance sheet for, we have to account for some of the things that happen that might adjust these balances for consolidation purposes. So anything you see highlighted here in the blue, those are from the statements of Red that we had on July the 31st. Anything in green is from the statements of Saks as we saw them on July the 31st at carrying value. So now, if we prepare the consolidated statements, we're not using a worksheet, we're using what we call the direct method. So how does that work? Don't forget, when we prepare consolidated statements, under the acquisition method, we said we take the carrying value, account by account, for the parent, Red, add to it the fair value of Saks. The fair value is made up of two pieces, the carrying value plus the fair value increment. This is your 468. The reason I'm separating them out is we're going to see in later chapters that any of these purpley guys, these increments and decrements, get amortized. So I'm setting you up now for this because you're going to see in later chapters that what we're going to do is amortize those increments. So I like to spotlight them or highlight them here so that you see them separately. But you can see here that we are following the acquisition method discussed earlier in this chapter on business combinations. We're adding to the carrying value of Red the fair value of Saks. All I'm doing is splitting that fair value up into two pieces, carrying value plus the increment. All right, so now you can see that we also have to account for the fact that this 1.6 million did not include the 978,000 that Red paid when they affected the business combination. That's why I had this little guy here in red, right? So we have to deduct 978,000 in cash because it's the day after July 31st. This is the balance on July 31st. It didn't include the 978,000 that was paid August the 1st, so I have to adjust it for that. Similarly, when I'm calculating the plant and equipment asset value at net, I'm going to take the carrying value of Red's PP&E assets at net and add to it the fair value, which we know of Saks's assets is 972, but I'm splitting it up between carrying value and the increment because what we're going to see in later chapters is that's going to be amortized. If we go to the patents, there were no patents on the books of Red. There were none on Saks books. They had them, but they valued them at zero. But we set up the increment on the consolidated balance sheet. Notice these increments don't appear on any separate entity books, neither Red's nor Saks. They're on the consolidated books because we're accounting for the business combination. So we're doing the consolidated statement now. So that's going to give us 72,000. And don't forget your goodwill that you calculated. So now you've got a balance sheet, total assets, 3.298 million. Let's hope that we get the same on the current liability and on the liability and equity side. And we do. We add together the carrying value of Red's current liabilities to the fair value of Saks's. Well, the carrying value and fair value are the same at 252. We can see this in the question. So now we've got 1,612,000 for current liabilities. With the long-term debt, don't forget under the acquisition method, to prepare the consolidated balance sheet, we take the long-term debt at carrying value for Red, add it to the fair value of Saks, which we've split up into two pieces, 360, which is the carrying value, plus the increment, because these increments get amortized later. And that gives us 864. Common shares, notice we've only got the common shares of the parent company, Saks. Now, if you wanted to do all the, what I call the in and out, you could say, well, I've got here 720,000, which are the common shares of Red. I've also got the common shares of Saks, which is 168. But don't forget, when you did your acquisition eliminating entry, you eliminated those guys, right? So instead of doing plus 168 minus 168, it's just 0. So that's, I'm only left with the retained, or the common shares of the sub. Now, similarly here, let's deal with this 18,000 a bit later. I could add in here the retained earnings of the parent company, which I know are 120, and add in that of Saks, which is 480. But then don't forget, I also would have subtracted that 480,000, right, when I eliminated the retained earnings of Saks up here in the acquisition eliminating entry on the consolidated books. And because I'm doing a consolidated balance sheet, don't forget, none of the carrying carrying value of Saks on their books includes that 480. But on the consolidated books, the shareholders of Red are not interested in the retained earnings of Saks. They're interested in the retained earnings of Red, which is this guy. Now, you'll also notice here, so again, this kind of flunks out to 0. So that's why I don't include it. Now, same thing here. This guy here flunks out to 0, so we don't include it. Right? So now, the reason I've got this 18,000 is, don't forget, this was the professional fees expense that I included in part A of the question up here, right? Professional fees expense. Well, don't forget, at the end of the year, what would have happened? Red would have closed that out to retained earnings. So because this is the retained earnings balance before the business combination, this is at July 31st, but on August the 1st, they debited those professional fees expense. So to prepare consolidated statements, each separate entity would have closed out their books before preparing the consolidated statements. So I have to kind of treat this as a closing journal entry, because when I closed, I would have debited retained earnings and credited the professional fees expense to zero it out. So assuming that closing entry, okay, or that closing entry would have been not made at this point in time, July 31st, but now we would close out the professional fees expense and we would have on a consolidated basis retained earnings for Red of 102. And that would balance our liabilities and equities to our total assets section. So that concludes part A of the problem. In the next video, we'll tackle part B, which is still a purchase of shares, but for this case, instead of paying out cash to effect the business combination, Red bought the shareholders of Saks their shares in Saks from them, but in exchange, instead of giving them cash, Red gave Saks shareholders shares in Red. So we'll do that illustration next.